SOFI stock just released their Q4 2024 earnings, and after a brief spike in price when the earnings were released, the stock found itself down 15% in the pre-market. So in this video, we're going to be talking about whether or not the 15% drop in price is justified, and whether this is actually a warning sign of things to come, or is this just overblown as usual? Because at the time of recording, SOFI stocks seem to have found a bottom. Therefore, I think we do need to dive a little bit deeper below the surface to understand what happened during this earnings call, because I noticed three things in this recent earnings that could actually change the way we value this company. And by understanding these three factors, it could help us better understand whether or not SOFI still has the potential to achieve the lofty targets they have set for themselves. But as always, potential is a dangerous word, so let's dive in. I'm going to spare you the build up and actually get straight to the point. You see, my initial reaction to SOFI's most recent earnings was actually also one of frustration. Frustration because, their earnings actually turned out pretty good this time around, but I felt like they really let themselves down when it came to their guidance. And so while I'm tempted to direct some of this frustration at management, I also realized that a lot of this frustration has to be directed at myself. You see, because I did not trust my own reasoning, pushed it to a side, and decided to follow the narrative that was surrounding SOFI stock in the lead up to their earnings, that Anthony Noto and his team were going to go for their PSUs, and I was doing all of that without any concrete evidence that they were going to do so. So you see, being caught up and being overly focused on all these PSUs as if management were going to, want to drive the stock price higher up to a certain price point by a certain date, I actually missed the bigger picture. And in these recent earnings, Anthony Noto and his team demonstrated that they're really focused on delivering long-term shareholder value and not just on achieving certain PSUs. And this was actually the responsible thing to do. Now, if I had no expectations for the PSUs, I would have no problem with their guidance. And I would like to say that, there was no way I could have known for sure. But I mean, okay, saying it out loud now, it sounds quite dumb to say it, but there was no way I could have known for sure that they would have chosen the responsible thing to do, focusing on the long term and not be distracted by some bright, shiny object, right? And that being the PSUs. Because, focusing on these bright, shiny objects could actually set the company back a couple of years in terms of their growth. Because what they could have done is they could have very easily optimized the business for earnings per share, but that would actually leave them unable to invest and take advantage of what they claim to be a strong macro environment. There's this concept known as the diminishing marginal utility, and this concept can be applied to a person's wealth as well. And this is just a very complicated way of saying that, as a person gets richer, every incremental dollar added to his or her net worth actually brings about less happiness, satisfaction, and purpose. Now, and because of that, when I did a quick Google search, you can actually see Anthony Noto's net worth anywhere north of $100 million. Depending on which article you read, it can be close to $200 million. So of course, if you ask me, I definitely do think that he'll be happy to receive every single tranche of his PSU. But realistically speaking, there's no real incentive, no real financial incentive for him to do so beyond the fact that, he can actually accumulate a larger amount of wealth, which I have just mentioned, beyond a certain point doesn't actually bring about real happiness, satisfaction, and purpose. And I do believe, for many of these CEOs, Anthony Noto included, they are beyond that point of wealth where, every incremental dollar starts to bring less and less happiness, satisfaction, and purpose. And so in simple terms, I think for many of us as investors, we are at a point where, $50 million seems like a huge amount. It can be life-changing for many of us. But for someone who has over 100 million, over close to 200 million in net worth, that is no longer going to be a strong incentive for him to drive any sort of action. So I think beyond that, if you just listen to Anthony Noto speak over the last couple of years in the earnings call, which is why I'm really beating myself up about this, I think we can all agree that he doesn't sound like someone who is driven by increasing the number in his bank account. I believe Anthony Noto is a mission-focused CEO like many of these other CEOs out there who are in a position where they actually already won the money game, and for them it's all about creating a legacy. And therefore, I do believe that he's after more than just another big paycheck. Now, if you take a look at Anthony Noto's history, his career, and everything he has done to date, I would think he liked the idea of, being seen as a Jamie Dimon type figure in the finance space at the later parts of his career. And if that's the case, I think what is the most important to him right now is maintaining his track record of having delivered consistent growth throughout various macro environments. And so that is way more important to him than achieving some PSUs. And I think how he actually sees this whole situation is that if I'm trying to achieve the PSUs, SOFI would probably have to take on more risk than necessary and at the same time sacrifice growth to achieve this, and it is not worth the trade-off. Now, granted, to be very fair, I don't actually believe that the level of growth that investors are expecting him to guide for requires a significantly higher amount of risk, but that is just my perspective. So therefore, because of this, moving forward, I'm going to try to be a little bit more objective and exclude the PSUs as part of how I view the company and how I view management's actions, and just answer the fundamental question of what is the logical next step that SOFI needs to take in order for them to become a top 10 financial institution. Because management's behavior tells me that the PSUs to them are a good to have, and if you ask me, I still think that it is likely that they achieve their first tranche fairly easily by the end of this year, but anything beyond that is a bonus. So I'm not saying that SOFI will never hit the $35 to $45 range, but what I am saying is that in terms of management's perspective, they don't seem to be actively pushing for SOFI to reach that range by middle of 2026. And so if we think about the loan that Anthony Noto took out back at the end of last year, I think that all that told us is that he expects SOFI to be above $30 by 2028, which is a 26% CAGR from today. But of course, in all likelihood, I do think we will be past the $30 range way before 2028, especially if the macro environment holds up. Now, with that out of the way, we can start to talk about the numbers, and I want to begin with what actually caused the 15% collapse in share price. And I believe that is down to their 2025 EPS guidance. I think many of the analysts that were looking at SOFI stock, they were actually expecting SOFI to guide EPS somewhere between 28 to 29 cents. However, in the end, SOFI actually came out and guided for 25 to 27 cents. Now, if I were to look at this whole situation objectively, and if you've watched my video in the past, I think I've mentioned that to date, while a lot of the economic data actually has come in pretty good and shows a strong economy, it's ultimately backwards looking data because, forward looking data still remains a little bit unclear about what we should expect. Now, on top of that, I think people are also worried about Trump's policies, like his tariffs. And if you look at how he actually handled the whole Colombia situation, tariffs do seem to be like a negotiation tool in that particular instance at least. But in other instances, tariffs might be something that he really applies to a country and it's not just a negotiation tool. So at the end of the day, I think there's a lot of uncertainty with how Trump's policies will play out and whether or not the economy can actually take all these changes in his policies. But if inflation is coming down faster than expected and interest rates remain elevated for too long, then the Federal Reserve do risk over tightening, because I think the Federal Reserve is likely going to pause in their next FOMC meeting, and if they're overly restrictive, we might actually see a slowdown in the economy over the next 12 to 18 months. And being outside the US, I can only follow the data and not actually be 100% in tune with what is happening on the ground, but my approach to 2025 has always been one of cautious optimism, and that means that I don't think a recession is necessarily imminent, but I can't totally rule it out as well, and I do believe that that is actually reflected in SOFI's guidance. And I guess if we were to try to understand this through the lens of legacy building, then Anthony Noto wanting to be seen as a Jamie Dimon type figure eventually and having that kind of authority, this is exactly what SOFI should be doing. They have to be a little bit more on the conservative side. Now, with that said, I do think that SOFI's management themselves has actually caused a little bit of confusion with their economic assumptions, because over the last couple of months, they have actually been telling us that, they see a very strong macro in 2025, and Anthony Noto himself has also said that this is the strongest macro environment that SOFI is operating in since he took charge. However, their actual economic assumptions doesn't reflect that. You see, in 2025, their assumption is 1 to 2% GDP, 1 to 2% GDP growth, as well as unemployment normalizing at 5%, and that doesn't actually reflect a very strong macro environment. And so I think this is what eventually brought the stock down. I think if you have watched my channel for some time, I hope you know by now that I try to be as objective as I can. And I'll be the first to admit that when I looked at the earnings, when earnings were first released, my reaction was exactly like the stock price, right? The stock price actually shot up before eventually crashing back down. And so when I took a look at the numbers, I was actually stoked about the revenue number, happy about the EPS, and then let down by the guidance. And this is why I absolutely love investing, because I'm reminded of this Peter Lynch quote where he says that, in investing, your stomach is way more important than your brain. And I do get the frustration around their earnings, but if we are honest with ourselves, our frustration at management is a frustration that they didn't hit our targets for their business. But how we should be investing is to track what management is tracking, what management is measuring, using some of these metrics to value the company and to ask ourselves whether the valuation and the returns make sense. You see, our job as investors, primarily we are capital allocators, and nobody knows your own situation better than you, and there is no right and wrong here. So if one day the returns don't make sense for you, then you can always move your capital around, reallocate it somewhere else. But for me, personally, I prefer investing with a longer term time horizon, and I don't make any decisions on days when I'm frustrated, and I don't make any decisions on days when I'm overly happy about the stock price movement as well. And so disciplining yourself to take the right action despite your emotion is an important skill that as investors we have to keep getting better in. But there were 3 things in this most recent earnings call that actually helped me put things into perspective, and the last one is exactly why I realized that my initial frustration around their earnings might have been misplaced. And the first thing I actually want to talk about is the possibility of investors actually underestimating the growth of SOFI's loan platform business. You see, I think SOFI previously said that they're expected to do, or at least they're likely to do, more than 600 billion in loan platform originations in 2025. Now, at that point in time, I think this was in Q3 of 2024, some people actually wondered whether or not this was a stretch. But this $5 billion deal that they have just signed with Blue Owl actually represents $2.5 billion a year in loan originations. Now, this one deal is nearly half of their entire originations they're expecting through the loan platform business in 2025 itself. Now, if you assume a 4.5% to 5% fee, then revenue generated just by this contract for SOFI in 2025 will be around $112.5 million to $125 million for the entire year. And if you expect margins to end up anywhere between the 20 to 30% range, this is equivalent to around $22 to $37 million in net income. So if you want to put things into perspective, this one deal by itself with Blue Owl represents around 4% of 2025's expected revenue and 8 to 10% of their earnings per share. May I remind us that this is actually just one contract from one segment of one business vertical within SOFI's entire business. Therefore, if we were to just look at the numbers and disregard their guidance, this was actually a fantastic quarter, and the numbers actually tell us that they're more than likely to beat their own earning estimates again. And the issue with their guidance is that they basically just set us up for another year of volatility in the stock price, having to wait for their execution to be realized by the streets eventually. Secondly, I think when it comes to the tax rate, as SOFI reaches a full year of profitability, this is something that we have to put a little bit more thought into as we do our valuation. And I just want to be very clear as I cover some of the things to do with taxes over here. Now, I've never had an investment thesis make or break because of income taxes being paid, at least when it comes to US and Singapore companies. But I think it's important to understand how it actually affects a company's earnings and to manage expectations moving forward. Now, regarding how SOFI's EPS actually came in at 29 cents this quarter, Team Sweeney actually broke it down for us very clearly on X, and I'll leave the link to his X post down below. But the main idea here is that they had some deferred tax benefits which they used this quarter, and in his estimation there's still around 5 cents worth going into 2025, and this will be additive to their EPS number. So I just want to put a very quick disclaimer over here. I'm not saying that I'm some expert in US taxes, but from what I see, there's 2 components over here: the federal corporate tax, which is currently at 21%, and then they also have the state corporate tax, and that is perhaps how SOFI gets to the 26% effective tax rate. But if this administration is more business friendly, that could actually mean lower tax rates, and if my US viewers can confirm this, that would be great. But I've read that in California there's this thing called the apportionment rule for taxes, so which means that they tax companies based on how much of their business in terms of their customers and their employees, etc., are based in California itself. So being a digital bank, I'm not too sure how high will this be for SOFI. But in any case, I guess if you imagine that SOFI brings in revenue of $100 with EBITDA margins of 30%, means they make an EBITDA of $30, and this is being taxed at a 26% tax rate, right? That would amount up to a $7.80 paid in taxes. Now, if they actually reduce their effective tax rate to 21 to 23%, then the amount paid in taxes will be reduced from $7.80 to anywhere between $6.30 to $6.90. And what that means is that SOFI actually saves around 90 cents to $1.50 in taxes. And if you consider that they're operating their business at around a 10% net income margin, that would mean $10 in net income, and you add on the 90 cents or $1.50, and that would amount up to a 9 to 15% increase in terms of net net income. Now, what that means for SOFI itself, if I bring it back to SOFI's case, if you consider SOFI's EPS guidance of 27 cents, you add on the 5 cents in deferred tax benefits that Tim has broken down for us in his X post, again, link down below, and then you add back this 10% of taxes for a friendlier tax environment, that would take SOFI's EPS all the way up to around 34.7 cents or 35 cents, right? And if you take a 80 times PE multiplied by 35 cents, that is how you get $28, which is near their all-time highs, which is basically my prediction for SOFI's price by the end of the year. And all of these incremental earnings are just based on tax regulations and not assuming any operational efficiencies that they're going to experience. So this makes me really bullish when I just look at the numbers itself, because we have to bear in mind that the share price will likely only appreciate towards the back half of the year as we see this thesis play out. But it's exactly this third point that made me realize that perhaps my focus on the PSU and my frustrations about them is actually wrong. Because during the call, Dan Doller from Mizuho actually asked Anthony Noto to elaborate a little bit more about their conservative stance, and I'm just summarizing what Anthony Noto's reply is in my own words. You can actually see his actual reply over here, but I'm basically summarizing it for him. Now, he's basically saying that back in 2023, we were focusing on revenue growth. Now, because of various factors such as the bank charter requiring us to be profitable within a certain time frame, as well as the macro environment, we've decided to shift our focus in 2024 to achieve profitability. And we have just shown you that with a snap of our fingers, we are able to operate at a 25% revenue growth with nearly 40% in incremental margins. And now that we have proven you that that is indeed possible, we are turning our focus back to growth in 2025 and only pulling the lever on profitability when growth rates start to slow down and we become a more mature company. I think this tells me two things. Now, firstly, Anthony Noto acknowledges that guidance for EPS is not where investors want it to be, and he justifies this by telling us that, hey guys, the strategy has changed. And this change in strategy basically shows me that he is in it for the long haul, because he's not just merely motivated by achieving some short-term PSUs, but because he sees the opportunity for growth for SOFI's business right in front of him, and he's willing to forego some levels of his PSUs to go after these growth opportunities and to reinvest in the business. And I think he's executing in a way so that SOFI can get to where he envisioned them to be, which is a top 10 financial institution in the US. And secondly, I think this tells me that most of our current valuation models are not accurately reflecting SOFI's business. You see, I think everyone is kind of expecting revenue growth as well as EPS to trend up together in lockstep. But according to management, that is not the case, and that is not their entire strategy at the moment. Right? Their strategy going into 2025 seems to be, let's ramp up revenue in the 2025, and when the time calls for it, we can just flip the switch and ramp up our profitability. Now, at the end of the day, we need to be honest with ourselves, because I do see a lot of frustration out there among the SOFI community saying that this management sucks, this management is horrible, and things like that. But I ask you to take a step back and to look at the numbers for yourself. If a company delivered these numbers that I'm showing you over here, will you consider the management as bad management? Hi, this is post-production Elijah over here, and I think when I was editing the video, what I've realized is that when I was doing the actual filming, I had the numbers up, so this part of the video actually made sense, but on editing, I realized it wasn't very clear. So basically what I mean over here is that when you look at what they guided for in 2024 and what they actually achieved, they were actually miles apart. So if you take a look at the guidance for 2024, in terms of their lending segment, they expected revenue to come in at 92 to 95% of 2023 levels, which means a decline in lending revenue, and for financial services and tech platform to grow at a combined CAGR of around 50% year over year. So if you actually do the math yourself, you actually realize that SOFI expected lending revenue to come in around $1.27 billion, financial services revenue to come in at around $676 million, and the tech platform to generate anywhere around $440 million in revenue. And so that would put their entire 2024 revenue at $2.386 billion, which is a 15% year-over-year growth. Now, if I were to put these numbers side by side with what they actually achieved, this is how it would look like. The adjusted net revenue basically came in at $2.6 billion versus the $2.38 billion that was expected. Adjusted EBITDA also came in higher than expected, $666 million versus the $590 million that they guided for. And net income, this actually came in at $227 million compared to the $105 million that they guided for. And finally, in terms of their EPS numbers, which is what most investors are interested in, that came in at 15 cents versus the 7 to
to 8 cents that was guided, as well as tangible book value growth of over $1 billion versus $300 to $500 million that was guided.
You see, the only bad thing about this current earnings was actually the guidance, and the reasoning that they gave was because of tax considerations as well as a shift in strategy back to focusing on revenue growth. So for me, this was actually a good earnings, definitely not a great one, because I still think that there's some disconnect between what management has said and the numbers that we see in front of us. For example, their shift back to revenue growth did not match their guidance in terms of their member growth, and I also don't understand why SOFI actually views a 30 cents EPS guidance as too risky, and why they take on such a pessimistic view of the economy despite saying that they see a strong macro environment. But if the company is shifting their focus back to revenue growth, then that is how we need to judge their execution. And because of that, I think it's all the more important to take a deeper look at the numbers that they reported in this most recent earnings, and I cover more of that in this video over here, and I'll see you in the next one.